Over to Korea and take a look at the Korean markets. The Kospi there is gaining by around 1.4% right now, 1,629. Taking a look at the currency now, the currency reaction, of course, to the BOK, leaving rates on hold for a seventh straight month at around 2%. The central bank has said that the economic recovery is still very much in the early stages and inflation is stable, but the BOK has refused to rule out uncertainties that continue to hang over the economy. Well, Daniel So is regional economist at Forecast. He joins us now from our studios over in Singapore. Daniel, great to have you with us today. We, of course, have seen the BOK leave interest rates unchanged, which was pretty much as you expected them to do. But I guess the focus really on the commentary. What are you looking for from the BOK?
That has been in recent days or session that we have seen the Treasury market actually starting to factor in at least a 25 basis point hike as early as November or December. But I still maintain my view that BOK is unlikely to rush into nominalization of interest rate until the first quarter of 10.
That's a great point because among the initial analyst comments that I saw right after that interest rate decision, 5 out of 5 said they only expect an interest rate hike in the first quarter. And what is interesting to note is that we're actually just getting commentary right now from the Central Bank of Korea saying that there can be cases in which the policy is deemed to be on an easing bias even after interest rates are raised. So the BOK now already talking about interest rates. Why are they doing this?
I think they are trying to boost their credibility because if you look at the fundamentals or if you look at the performance of Asian economy, South Korea and China or maybe Indonesia will be one of the first few to normalize the interest rate. And there have been talks about excessive liquidity driving up asset bubble. So they are trying to convince the market that they will do certain things if necessary to contain inflation. But if you look from the broader perspective, the deflationary gap is still huge in South Korea, and they are unlikely to use monetary tools to tackle suppose tradable inflation due to the rise in oil prices. So and private consumption and investment are still fragile. So I don't really see a rush or a need to raise interest rate. And of course, the most important thing is the South Korean won, which has boosted the economy during this global financial crisis. And they may lose some of its competitiveness if the dollar fundamental weakness come in, and especially for the yen. So policymakers have to factor in all these things to do their monetary policy adjustment ahead.
What was interesting to note is that, in fact, just a few days ago, we had conflicting comments from the finance ministry and also the top-run, state-run think tank, which is actually affiliated to the finance ministry, the KDI. Finance ministry saying we need to keep these easy monetary policy rules in place. On the other hand, the KDI saying no, the government needs to start tweaking those rules. Why are we getting conflicting signals considering that they're actually part of the same family?
I don't think the signal is conflicting in the sense that the finance ministry is trying to say that an exit strategy in terms of focusly on rate will have to come looking in line of economic development or economic recovery from a global perspective. Our KDI is talking about more of emergency measure financial rather than specifically rate policy. But a lot of the things that they have done, they should actually start to unwind them. So it's more of an emergency measure from the KDB perspective, and maybe slowly into rate normalization, while the finance ministry is just trying to say that, we should keep rate low and the easing appropriate.
So KDI people just doing their job, basically.
Daniel, let me jump in here and ask you about the Taiwan, the Premier's surprise resignation that we had earlier on this week. We haven't seen too much impact. A lot of analysts are telling me that there isn't really going to be too much of a long-term political or market impact, in fact, from this move. But I guess, does this mean that cross-strait relations are actually going to be able to improve over the longer term?
Pardon, I can't hear your last question.
Does this mean, Daniel, that cross-strait relations are going to improve?
Yes, of course. I mean, the newly appointed Premier Xi actually said that they will stick to predecessor policy and also aim to improve cross-strait relations. So this will allay concern about any uncertainty to policy orientation or the geopolitical tension across the cross-straits. And you can see from the portfolio surge in portfolio equity inflows into the Taiwan stock market over the last few sessions. So foreign investors are trying to assess the significant spillover effect of a financial agreement across the strait, and that's actually, I will say that I'm very bullish for Taiwan stocks and for the Taiwan economy as a whole.
All right, Daniel, look, great to have you with us today. Unfortunately, we're out of time. Thanks for joining us, Daniel So from Forecast.